Hello everyone, so we're taking a quick moment to further explain the T, or what we call the split funding at the kitchen table. First and foremost, make sure that you watch this video repeatedly. Make sure you take notes, make sure you listen in the car. The more you watch and the more you listen, the easier it's going to be for you when you sit down at the kitchen table. This presentation is good for you also to catch someone's interest in recruiting. You can do this on a napkin. Most importantly, just remember that the whole purpose of this is to put the crusade inside of you. Okay, why Art Williams built this company and why we've had a successful track record over the last 40 plus years. Okay, this is the example that we use at the kitchen table. We call it the T as mentioned, or the split funding. So this is an example of an actual client that we had. Okay, before I sat down with the client, I wanted to know exactly what type of policy he had, and how much of insurance monthly premium he was paying. I'm going to tell you this right now. Most clients don't know the actual name of the policy. They just know that it has a savings component attached to the monthly insurance premium. Okay, so this is an example of a client that had a cash value policy. Now, just know that cash value policy, the amount that the client pays are normally really high. Okay, so here's what happened. So the client, just to establish a fact, he was paying $1,200 a month for insurance. Okay, so what I did is I asked him how much are you paying. He told me $1,200 a month. Another fact is that he had $500,000 worth of insurance coverage. That's how much he had of insurance coverage, right? So what I did is I simply drew what's called a T, right? Split funding. I drew a T. And then I said, okay, well, on one side, I'm going to show him that he has $500,000 of insurance. Okay. Then I opened up the policy and I noticed that this client did have a savings vehicle attached to it. And what happened is that 20 years down the line, right, what the policy stated was that he was going to have $282,000 savings attached, give or take. Okay. Now, there's a couple of things that he didn't know. And then I went in through the policy. And by the way, most cash value policies work this way, right? But what I did was I said, okay, Mr. Client, I'm going to look at a couple of things and I'm going to identify what type of policies do you have, right? Now, just know, and let me pause here for a second, but just know that this is an example, or this is a presentation that you could do with the client as an example, whether the client has a policy or not. What you're doing here is educating the client on the different type of policies that exist, right? Because not all policies are going to have these couple of components that I'm about to mention, but most of them do. Now be very careful. Your job as a licensed agent is to pick up the policy, go through the policy at hand with your peers, with your vice presidents, so that you have a clear understanding so you can talk to your client about it. But this is a small napkin presentation, whether it be whether the client pays 1,200 or whatever the amount is. This is just a presentation. Okay, now I said, Mr. Client, I'm going to draw the T and I'm going to show you. And I said, on one side you have $500,000 worth of insurance. 20 years later, it states that you're going to have 282 grand. Said that. There's a couple things with your client. Number one, did you know that for the first 5 years, there are no savings on this account? So that means that you've paid, $200 a month for this policy. Okay. Almost $1,200. And for the next 5 years, you have no savings accumulated. He didn't know that. Well, that's insane, right? Because that's like you putting money away in your bank account, and then your institution 5 years later tells you have no cash value. Would you continue to put money in your bank? I highly doubt it, right? Then number two, what we did the math, right? And we said, Mr. Client, did you know that what you're paying on, the money that you're paying on a monthly basis, what they're guaranteeing you, it's 1.5% rate of return, which is called ROR, rate of return, over the next 20 years? He didn't know that. He knew that he had a savings, but he didn't know that he was only getting 1.5% rate of return, right? So just to clarify this for a second, you can actually invest in different products that can give you about 9 times that amount. Okay, and that's obviously gonna triple, quadruple, your money over the next 20 years, versus this client was only getting 1.5%. But wait a second, inflation is going about 2.5%, 3%, but this client's only getting 1.5%. He didn't know that. We identified that. Number three, we identified that he had to pay 10% to borrow money in interest. So just to go back to the bank example, let's say you had money in your bank and you wanted to take out $20,000 to buy a car. What if you had to pay interest on your own money? Would that be fair to you? Of course not. That's your money, right? But in this example, the client had to pay, and in the state of Florida, by the way, because this is Florida where we're at right now, it is legally for them to charge you up to 10% on your own money. That's not fair, right? The client wasn't happy. He wasn't aware of that. He said, "It's my money. Why should I pay?" I said, "That's okay. They didn't tell you this thing, right?" Number four, they deduct if you die. What does that mean? Okay, Mr. Client, did you know that if you had money loan out, let's say you did accumulate, 100,000 or $200,000, right? And then you took out 50 grand or 100,000, let's just say 50 grand to buy yourself a car and a boat, right? And then you happen to pass away because, by the way, insurance is in case you die. That's the purpose of insurance, right? A risk transfer, right? So what happens if you pass away? Well, guess what? Those $50,000, they're gonna deduct it from your face amount. So your family is supposed to get 500,000 plus the savings. That's what logically is supposed to happen. But unfortunately, guys, they keep the savings, and whatever you had borrowed out, they did reduce that or deduct that from your face amount. So in this example, his family would only get 450,000 versus the total 500,000. So that doesn't make any sense, right? I hope I'm building up some character here. And then, of course, the other thing that's crazy, as mentioned, is that they get to keep the cash in case you die. And by the way, if you're licensed in the state of Florida or in any other state, you already know that it's either or, depending on the type of policy, because there's a corridor, and it's either whichever or is higher. And then this most example, in most cases, the face amount is going to be higher than the cash value. So that alone states the client just didn't know. So I said, "Mr. Client, if your policy worked this way, is there any way that I can get you to keep it?" Of course, he said. Of course, he said no. So at this point, I drew a T on the right-hand side, and I said, "Okay, well, look what I could do for you." I said, "Look, I can give you the $500,000 in coverage, but let me ask you, why 500? Why do you have $500,000 in coverage?" Well, he told me that he actually needed $1 million, but he couldn't afford it. And the reason why he needed $1 million is because he has a property worth $1 million or left $1 million. So I said, "Wait a minute. So you're underinsured?" And he said, "Yes, I'm underinsured." By the way, most clients that own cash value policies are underinsured because they have a high premium and they can't afford more because it's already too high. So they're way underinsured. So I said, "Mr. Client, so let me get this straight. You need $1 million, right?" "Yes." So I quoted him $1 million, and I said, "For $1 million, I can give you $1 million for about 180 bucks a month." Guys, listen to that. 1 million for 180 bucks. And he says, "What about the rest?" I said, "Look, if you want to go ahead and invest the rest with me, just call it an even $1,100, and you put it away into a mutual fund at an average rate of return of 9%, which you can get 20 years later. It's north of $800,000. Okay? Mr. Klein, what makes more sense? For you to get $800,000 plus $1 million for the same amount, or for you to get 282 with obviously all that's tied into it?" What do you think he said? We have closed, educated the client, and within 15 minutes, we had him closed. Now, what happens is that the reason why it's, obviously a lot better on the right side versus the left side, it's because we also believe in saving and, buying insurance and savings for the future, but we do it separate, not together. We do not bundle the products because when it's bundled, the insurance company is in control. When it's separate, the client is in control. So you're going to ask the client. So, "Mr. Client, what makes more sense, A or B?" B being the latter, client's going to say B. And we'll say this is the reason why in A we call 2 for 1 because you pay for 2, but you only get 1. And we call B 2 for 2 because you pay for 2 and you get 2. So guys, I hope this helps. If you have any questions, definitely contact your vice president, any peer. But make sure that you practice on your own. Make sure you practice in front of a camera. Make sure you practice with your peers, significant others. Get this right. As mentioned, listen to this as much as you can because this is what's going to elevate you to the next level. Okay? Thank you so much. Have a good one.